How do you actually know whether the apartment you're booking today will get completed tomorrow? Most buyers trust a builder based on brochures, branding, and sample flats without understanding what actually keeps a project financially alive. Welcome to the Realty Engineers Homebuyer Guide episode 2, and here we are discussing about the financial terms in real estate. Today we are understanding how to evaluate builders not through the brochures but through execution visibility. So let's dive into one important question. Can the builder realistically complete this project properly and on time? First, let's understand how projects actually get built. Most residential projects are not built entirely using the builder's own money. A project usually runs on a combination of builder's capital, bank funding, and customer collections, which means when buyers start booking apartments, that incoming cash flow becomes a very important part of the project cycle. Now, years ago, this is where many problems used to happen. Some builders would launch multiple projects, collect money from one project, and divert it somewhere else, which affected construction timelines, cash flow, and sometimes even project completion itself. And this is one of the major reasons why RERA became such an important shift in Indian real estate. Because today, there are rules designed specifically to reduce this kind of risk for home buyers. And one of the biggest among them is the escrow account system. Now, this sounds technical, but actually very simple to understand. And once you understand this, you will start evaluating builders very differently. Let's understand escrow account in a very simple language. So what exactly is an escrow account? Under RERA, a builder cannot freely use all the money collected from buyers. At least 70% of the customer collections from a project must be deposited into a separate escrow account dedicated to that specific project, which means that money is legally meant to stay connected to the same development. Now, why is this important? Because it reduces the chances of fund diversion. In simple words, a builder shouldn't take money from project A and use it aggressively somewhere else while your construction slows down. And there's another important layer here. Builders cannot randomly withdraw this money whenever they want. Withdrawals are linked to actual construction progress, which means engineers, architects, and financial certifications all become part of the process. At the end of the day, buying an under construction apartment is not just a property decision. It's a trust decision because for most families, this is years of savings, long-term EMIs, future planning, and most importantly, it's an emotional commitment, which is exactly why buyers should stop evaluating projects based on brochures and marketing. And we urge you to level up your research. This is Realty Engineers, and we will decode how to judge a builder credibility in our upcoming videos. So stay tuned. If you find this video insightful, spread the word and subscribe for more such videos.